the end of the year, we can keep people on point with their long-term goals and help them to meet their strategy and hopefully bring them to a point in their life where they've got that wealth that they've been looking for and that financial security. A very common way a business fails is actually growing too fast. They don't put the systems and processes in place, they don't plan, they overcommit.
People are a little bit wary of the HMRC.
One piece of advice I would give people though, if they're not helpful, I would just call back and you'll get somebody else that is helpful.
Hello, you're listening to Better Financial Futures. I'm your host, John Boatman. After 3 decades in financial advice, I've seen how small, informed decisions can transform someone's life. This podcast is my way of sharing that experience so that even one listener can take a step towards a better financial future. Now, today I'm really pleased to be joined by a friend who's relatively local to me. I've met him through business networking over the last few years. He is an accountant and he's going to come on and talk about his experience about money. So Steve Roberts, thank you very much for joining us.
Thanks for having me, John.
So tell everybody a little bit more about your personal and professional background.
Okay, well, professionally, obviously I'm now working in practice. I'm director and partner at Riverview Portfolio, which is a local accountancy practice focusing helping individuals and small to medium-sized businesses. Been here now for about 8-9 years. Prior to that, I worked in industry, a couple of different sectors, predominantly manufacturing and property and asset management, which gave me a good sort of footing into some of the key areas that I work with now with the smaller businesses. Over that time, whilst I was in industry, did my professional training, and then felt I should make the move into practice. Kind of had enough of big business, PLCs, wanted to make a difference, affect some change, and here I am.
Now, I know that we've had a discussion about your relationship with money. So just for the purposes of the audience listening and watching, obviously, we've talked before with guests about their relationship with money. Tell us a bit more about how you've learnt about money through your life and your relationship with money now.
I mean, my relationship with money is probably a little bit on the risk adverse side, hence my profession. But I mean, it was, I guess starting back at the very beginning, I learned my sort of core values of learning about money from my mother of all people, actually. I kind of feel like I'm showing my age here because I think my mum probably was doing it a pretty old school way then, and that makes me feel really old. But yeah, so she used to have a box, envelopes of money going in for different things, and it was all very we had a modest income, so it was a very strict budget. But that really did teach me a core value around, living within your means, which is really important, particularly, the decades I grew up when, institutions were throwing credit cards and loans at you, like it was free money, which clearly it wasn't. And then I guess I just going up through school, it was just something I had a bit of an interest in myself, and that was where I kind of learned about money, was actually reading about it, wanting to be entrepreneurial, or having an interest in business. It certainly wasn't, I know we'll probably touch on this in a bit, it certainly wasn't learned at school.
Yeah, you've got children, haven't you? So are they learning about money at school? I mean,
Lily, my youngest, is probably a little bit too young for your target audience, but my son is bang in the middle of where you're looking at, really. I mean, he's 20 and my daughter's 15, and their education comes from me. I mean, I've had extensive conversations about future planning, ISAs, pensions, that sort of thing with him already. Make sure he's doing it, from the beginning, so he gets that compounding benefit, should we say?
Absolutely. Now, going back to your mother, she sounds like a great mother, with the different envelopes. I love that, and so that would suggest budgeting. So, obviously, a big subject, and I think we've touched on budgeting before. It's so important, and you also touched on credit cards as well. Credit card debt. I've been in a situation before as a financial advisor where, credit cards were credit was so easy to get, wasn't it? And I think now with the keeping up with the Joneses and all the noise and all the information that's available about money. How just talk me about how do you talk to your children about money? Just as you've mentioned it, how do you kind of explain things in a basic way to them?
It's very easy to spend. I think that's the key bit that I tell them, that yes, you've got to work hard to earn your money. It's very easy to spend, but really, what you do earn, and it's the same in business, really. The money that comes into your bank, whether that's a salary or whether that's sales, that isn't all your money. It has to be, particularly from an individual perspective. You've got to be planning for the future. It isn't an option. It shouldn't be seen as an option. You should be budgeting for your everyday, budgeting for your short to medium future, and then budgeting for your long. I do fully appreciate. I fell foul of this when I was younger, having kids young and whatnot. That you do need cash today. So if you've got limited income or cost of living pressures, which is obviously what we're going through at the moment, saying to people, well, you've got to put 10% away for this, 10% away for that. It's all well and good, but if your rent's taking up 70% of your income or something like that, then it appears to be unrealistic. So I try and encourage, when I'm speaking to people, just small and little and often. If that's all you can do, yes, of course, it'd be good to be putting in more 10, 15, 20% chunks of stuff. But the reality is, I guess, if you're on a low income and all the other cost pressures that go on with living in the here and now, then that becomes tricky. People's expectation is that they are driving around in a relatively new car. And if you've seen my car, John, you know that isn't what I believe. People do expect a certain holiday. And, to a certain extent, these are the things that we want to be, we want to have, growing up in an established economy, mass consumer economy, all the messaging that we get around spending and whatnot. So I do really sympathize with the position a lot of people are in, particularly now. But you do have to prepare for the future.
So when you came into working life, you came. How did you fall into accountancy? Was that something you'd planned?
I didn't fall into accountancy as such. I actually spent most of my childhood wanting to either be an accountant or a solicitor. And then, shall we say, I lost a little focus, shall we say, around my late teens. Had a bit of a crisis about what I wanted to do, and went into sales on my gap year, that then became slightly extended. I was quite good at sales. I was quite happy doing sales, but after sort of 6 years, I was like, well, this actually wasn't a deliberate act, and I'm not sure I want to be doing this for the rest of my life. So I did then take the plunge and started doing my professional training college alongside my job. And then once I got my sort of essentially the junior qualification in accountancy, I then did make the move into industry, into my first accounting role when I was probably about 27.
So I would imagine that similar to the financial services industry, the industry of accountancies, because it is quite a long training program, isn't it? And to become qualified. And my father was a chartered accountant. So how have you seen it change over the last 14, 15 years?
Lots more accounting standards are coming in, lots more regulation, certainly larger business, internal, external auditing, as much as perhaps you wouldn't believe it with some of the horror stories you hear in the news. It's very, very thorough. I think accountancy now is technology, softwares, AI, that's become, that's come at the forefront of business now. And we also, particularly in accountancy, as we move into the next 5 years, decade, or the landscape will look quite different, I think.
Yeah, so making tax digital, isn't it? And,
Yeah, I mean, that has been very slowly rolled out, but that's probably another story. HMRC inefficiencies.
now I'll come back to HMRC in a minute, but you're obviously dealing with individuals and you're dealing with small to medium sized businesses. Would that be fair?
Absolutely, yeah.
And we both know that obviously running your own business is pretty tough. I believe the statistics are 80% of businesses, fail off within 5 years, and it's normally to do with cash flow.
Absolutely.
Is that your experience?
Yeah. I mean, lots of businesses start with good ideas. Lots of businesses start with good expertise, good knowledge, in their specific sector. What they might not be very good at doing is running a business, growing a business. Even a very common way of business fails is actually growing too fast. They don't put the systems and processes in place. They don't plan. They overcommit because things snowball. They've got a good idea, it works, and they keep doing it over and over again. Not realizing that actually, part of my role when I'm speaking with businesses that grow really quickly is trying to pull them back, to make sure they've got that infrastructure in place in their business, their processes, that they don't get caught out by VAT, that they can manage their cash. That's a very real problem. But you're right. I mean, the one that really does generally kill businesses is cash flow. An unexpected bill, overspending, directors that want a certain level of income prior to actually being there in the business, perhaps, shall we say. And of course, external challenges. I mean, certain sectors, you get into a business, make it successful, and then all of a sudden it seems like you're fighting on all fronts, whether that's changes in, legislation, more entrants into the market, pushing pricing, things like that. And they're all challenges that just because you're very good at doing what you do doesn't necessarily mean you can sort of manage and navigate your way through those. And unfortunately, that's why the failure rate is quite high.
Yeah. So just to keep going back to kind of individuals, do you think that sometimes, similar to financial advisors, individuals, whether they're running businesses or not, maybe an accountant is perceived as somebody that somebody with money would have, rather than having advice from an accountant, having a job, being a professional, not just a business owner? Do you think there's a perception that's...
Yeah, I think so. I think, there's, certainly, professional services in general, I think, are seen for a certain type of person, not necessarily for, man on the street. He's got a job, and why would he need an accountant? But certainly, particularly, even just as simple things as pension contributions, the more people that go into that higher rate, the more people are perhaps missing out on some tax relief. And it's those something people obviously perceive perhaps an accountant as being expensive, and not value for money. And if your affairs are incredibly straightforward, you work and you're in the basic rate, you might not need an accountant. But more and more, you're seeing that people being pushed up into the higher rate, they would need an accountant. And even my son, that's been going between different part-time jobs and having fun with having deductions about holiday, annual leave before he leaves, or being put on an emergency tax code or something like that, or having a really good month 1 month and thinking, why is he paid so much tax? Obviously, I guess perhaps they wouldn't go to an accountant for those types of things, but he's definitely been leaning on me over the last couple of years when he's been doing these jobs.
Yeah, I'm sure he's been leaning on you for
right.
his whole
Sure.
life. And I was going to just take you back for some of the terminologies there that you just touched on, right? Just to kind of go back for some of our viewers, you touched on top rate of tax or higher rate of tax. Would you mind just, in a very straightforward way, just giving us a little bit of background on when you start paying, how much tax you pay, and then the rate of tax as your income increases, just to give us a little bit of a kind of framework?
Everybody's entitled to, initially at least, their personal allowance, which is a an amount of money that you can earn prior to any tax being paid, and that's currently £12,570. Unfortunately, that's not changed for a number of years now. If we were living in slightly more progressive, with slightly more progressive policy, that would be higher, I'm sure. And then at the point where you start earning more than that, between £12,500 up to £50,270, you're paying 20% tax. So that's anything above that amount will be taxed at that rate of 20. Above that 50k threshold, you're going to be paying 40% tax up to £125,000. And then the additional rate of tax kicks in at 45%. Interestingly, you do have your personal allowance restricted between 100k and 125k, meaning if you do earn 125k, you won't actually have any of that initial 12.5k tax amount. Everything will be taxed.
So you're taxed differently at each bracket, aren't you? So you're not, if you're on 50,000, you're not taxed at 40% on all of the 50,000.
No, just the amount that is exceeding that threshold level. Yeah.
And do you find that people who come into come and see you about tax and national insurance and even just a payslip, sometimes people don't really realize what's going on within a payslip, or maybe they're a professional person, they're earning good money, but they're not aware of where their taxes are going, and also something called national insurance. Can you just explain what is national insurance, and that appears within someone's...
Yeah, sure.
I know it's different for someone who's employed to someone who's self-employed.
The national insurance is a ring-fenced separate contribution towards state benefits and pension, essentially. So it's kept away from the general income tax, and goes directly into the pot for predominantly state pension, NHS, and other benefits.
And so people are maybe coming into a job for the first time, and they're receiving a gross salary, so that's the figure before tax. And then they're being taxed, and they're having national insurance deducted, and maybe they're having a pension contribution deducted by an employer before they then receive their net pay, their take-home pay. Sometimes I think it is gross. It's not just gross in the... And do you think that I don't feel that's actually educated. I don't think sometimes people come into their first job necessarily knowing all these things. Would you agree? Or
I mean, the first time you receive a payslip, nobody has ever shown you what that is, walked you through it. And actually, I see a lot of different payslips, and I think some of them might even be deliberately a little bit convoluted, so you don't actually ever know whether your net pay is actually correct. Obviously, as you become higher earner, there's different deductions, your benefit in kind, things like that, maybe share schemes and things like that, which does then become a little bit more complex. But even when you're talking about your first pay slip, not to know the amounts that should be being deducted, it's not displayed very clearly as well. In any given month, HMRC will essentially assume that that's your annualized income, so that you'll be paying essentially 1/12 of your tax on that income in that given month. Now, if you do shift work or you do overtime, you're going to see quite different fluctuations in your tax deductions, and it could be quite clearly, displayed. This is your tax-free element. This is the bit of the basic rate. This is a bit of the higher rate, and these are the deductions. But certainly, I mean, somebody at some point, you'd hope, perhaps in school, might not be that way inclined with regards to numbers and things like that, but at least you know that what you're looking at, and maybe have some confidence around the fact that what you've been paid is at least there or thereabouts. Because it is only at the end of the year that HMRC will go, oh yeah, we've over collected or you've under collected, and then that will then go into next year's tax code.
There's a couple of things I'm going to ask you. So there's a document that people receive at the end of a tax year, or a document they receive when they leave a job, and there's also a tax code. Could you cover those three things?
At the end of the tax year, regardless of whether you've had different employments, you will get from your current employer a P60, which will confirm your total taxable income for the period, and it will then also confirm the tax paid. And that should be the correct amount based on your overall annual income. That tax collected is based on a tax code that you will be given at the beginning of the tax year, and that may change depending on your circumstances throughout that tax year. Now, everybody standardly is on 1257L, which means the 1257 it means that you've got your full personal allowance. So any young person going into the workplace for the first time, that should be their tax code. And if it isn't, that's something to grow with your payroll or HR department. And then if there are any adjustments required, so you haven't perhaps have underpaid in the previous tax year for whatever reason, then HMRC can use that tax code to say, well, we're going to reduce your tax-free allowance so we can collect the amount of underpaid tax. If your employer doesn't have sight of your tax code when you start a new job, you could get put on what we call an emergency tax code, in which case that generally would start with a K, and it would be assumed that you don't have any personal allowance. So in that scenario, you would be overpaying on tax, assuming you were entitled to the personal allowance, which would then get adjusted again at a later. So generally speaking, unless your payroll department has made a mistake in their calculations, if you've overpaid on your tax, it will relate to your tax. And then the next step is to understand why the tax code is correct, or indeed it can be incorrect. And then the third point that you asked me about was the P45. So the P45 would be the document your employer issues you when you leave a job, and it confirms again the taxable income tax deducted in that tax year whilst you've been working for that employer. Now, one page of the document goes to you, and one page of the document will then be sent on to your new employer, which will then hold that so they can then complete your P60 at the end of the tax year.
I do feel sometimes that I've found that people are a little bit wary of the HMRC, and maybe even phoning them. Can an individual phone?
I would encourage people to contact HMRC. I mean, there are other ways of doing it now. You can set up your own government gateway and get on, and you can see, your historical taxable income. They are slowly getting better at that. You can put through requests online. But if you do have an issue and you don't have an understanding around it, I would encourage you to call them. You will have to sit on the line for a while. I'd encourage to call first thing in the morning during the week. That's probably the least busiest time. And they are generally helpful. One piece of advice I would give people, though, if they're not helpful, I would just call back and you'll get somebody else that is helpful. It is really a little bit pot left like that, I'm afraid. But absolutely, they should be able to help you. It just might be a bit painstakingly slow whilst you get the call.
So at the other end of your working life, obviously some of the national insurance contributions have gone towards what you mentioned there, state pension. And now the state pension age is increasing. So is there a way of actually finding out or forecasting what your national insurance contributions are going to result, what the state pension is going to be for an individual?
I mean, the general consensus is to access that full state pension amount, you would need to have what they would call qualifying years, 35 of them. So essentially you'll have access to whatever the full pension of the day is when you get to that state pension, which again, obviously will be changing at different points for the next couple of decades, I'm sure. But as long as you do as it stands, those 35 qualifying years, you will have access to a full state pension.
So if, for example, you are a mother or a father that's taken time off to look after children, is there a way of making up for those lost years?
So you can opt to pay for missed years. Now they've recently changed that. So you can only go back 6 years, I believe. But yeah, certainly you can call and pay essentially what would have been a national insurance contribution for that year to ensure that you've got that qualifying year. And obviously, it makes perfect sense to do that.
Yeah, and when it comes to pension contributions that maybe your payslip has on it from your employer, sometimes an employer will, by law, have to provide a workplace pension. The pension contributions deducted from your pay, but sometimes you're making pension contributions yourself, whether as a business owner, whether as an individual, and you get tax relief on those contributions. So, for example, for every £100 contributed to a pension, it costs you, say, £80. If you're a basic rate taxpayer, if you're a higher rate taxpayer, you can claim back the other 20% tax relief, in essence, in simple form. So sometimes pension plans get criticized, because it's a long-term savings plan, but it's a great way of it's a very tax efficient way, without giving advice here on the podcast, but it's certainly a good mechanism to receive some tax relief on an investment, and then later on in life, release some of that money, some of it tax-free and some of it's taxable from within your pension fund. So I know as an accountant, you will use pension plans, not just because they're good for the future years, but they're also good from a tax efficiency point of view. Is that fair?
Absolutely, they're a great tool to use. Obviously, governments keep trying to squeeze these benefits, but absolutely 100%. Where if we're talking about advice to a young person around a work-based pension, then yeah, absolutely, you should be opting in. You should be making your contribution. Ideally, making a contribution that maximizes the employer contribution, because essentially the employer contribution is free money. So highly recommend people doing that. And it is very tax efficient because, yeah, again, obviously it's cash now, but it'd be cash now with tax deduction, whereas you can put it into a pension without having the tax deduction, as you said, the tax relief, and then giving it the opportunity to grow as well.
Now, just quickly as we come to close, just wanted to touch on something: sole traders and limited companies. I know it may sound obvious to you and I, but can you just give us a quick example of maybe how one or the other is better?
Yeah, sure. So, I mean, again, with the sort of change of government policies, some of the benefits between the two aren't quite as black and white as they used to be. But certainly, a sole trader is where you would be providing a service or having a business where you would be operating in your own name. So any profits that you do make would be taxed at personal income tax rates, national insurance rates. Essentially will pay tax on all of your income. And also, as of now, if your sort of income's over £50,000, we'll also need to report that on a quarterly basis as part of HMRC's Making Tax Digital. The limited company would mean that you're a separate entity, not operating your own name. And the limited part of the name is essentially telling you that you've got limited liability. So the concept of limited liability is that the business risk is limited to the business assets and liabilities. It's not it doesn't extend to you personally. Whereas if you're in a sole trader, your other personal assets would be at risk if something went wrong. It can put a house at risk if you've got large debts, for example. Within a limited company, yes, you've got to pay corporation tax on your profits, but then you do have the opportunity then to limit the personal income coming out, which can be a big tax, as well as obviously having other tax planning tools inside a limited company, asset purchases, capital allowances. Both are good propositions, depending on the type of business. And depending on the size of the business. It's a very general rule is that you would generally start as a sole trader, and as the business grows, they will get to a point where it becomes appropriate for you to open a limited company, move that sole trade business into a limited company. And then from there, you can obviously then look to grow the business further inside the limited company.
Just two other questions I've got for you. First question: is there any guidance you would give somebody listening or watching this in regard to accountancy, tax?
Yeah, my biggest piece of advice would be to engage with your accountant. I know obviously I'm slightly biased in saying that. Obviously, you can always buy a very, very cheap accountant and they'll fill in a form and send it off for you at the end of the year. But if you have a slightly better service than that, then I would say use it. these are people, financial professionals. They know their tax law. They know how the performance of businesses work, and they can give you invaluable advice. The two things that they need from you is data, which obviously is becoming much more easier now with cloud-based softwares, but it does still need to be kept up to date. And they need the business owner or individual to engage with their accountant, so we can start planning for the future. If we've got that level of engagement, we can tax plan. There aren't any nasty surprises at the end of the year. We can keep people on point with their long-term goals and help them sort of meet their strategy, and hopefully bring them to a point in their life where they've got that wealth that they've been looking for, and that financial security.
Absolutely, that's really good advice. That really is. I was going to ask you, it's a slightly personal question, and I know I've pre-warned you about the question. When we're going to ask you, as I do with all my guests, what would you say is the biggest financial mistake that you've made during your young life?
Yes. Well, thanks, Sean. That's very generous of you to say young life. I think I probably stressed the point on something we were talking about earlier on, and for this very reason, was because when I was in my first job, I opted out of my pension, because again, young, tight income, a young family, needed the money now rather than later. But you cannot ever replace the compound effect that you have when you start that investment early. Yes, you can put more in later life, of course you can. But as I stress to my son, start now, even if it's small. The compound effect of that investment rolling forward year on year, having a small contribution, hopefully with some strong economic growth benefiting the pension fund as well. You cannot ever get that back. So that would be my one piece of advice based on I would say was my biggest financial mistake.
Yeah, well, thank you so much for sharing that. That's very kind of you. And thank you so much for your time. Your grey matter has really been working hard there with the information you've shared, and I really appreciate it. It's so helpful, and it's so important to understand tax. I know it's not always the most exciting subject in the world, but I think it's so important, especially if you're new into a job. Or you're later in life and you're thinking about retirement. It's really important to understand your tax scenario, your national insurance situation, your tax code, and there's various P numbers, P60s, for example, that you mentioned. So I'm really grateful, and thank you so much for coming on the podcast.
Well, thank you for having me, John. I hope it's been helpful to somebody out there. Sure.
So my top tip is to review your tax code. And if you need to, speak to a professional, an accountant, but make sure you're paying the right tax